Mr. A.V. Powell is a consulting actuary specializing in consulting with retirement communities known as CCRCs, such as Pennswood, and continuing care at home, CCAHs. He pioneered the application of actuarial science mathematics to CCRCs in 1979, very early. And this work quantified the appropriate level of reserves and pricing margins for their unique contractual combination of lifetime long-term care insurance with managed care considerations plus senior living housing benefits, just like us here at Pennswood. His company, A.V. Powell and Associates, have been providing actuarial, financial, and planning services to the administration of CCRCs for over 40 years. This is quite rare. He really was an early innovator. Since 1985, his company has published 3 sets of standardized actuarial assumptions for CCRCs based on scientific experience studies from the largest database of CCRC resident organizations in the United States. He received his undergraduate degree in statistics from Harvard, a graduate degree in actuarial science from Georgia State University, and he completed his doctoral coursework in risk and insurance at the Wharton School. So I think he's pretty qualified. Please join me in welcoming him here tonight for the Forum Committee.
Thank you. I have spoken to resident groups before, but this is probably the largest resident group I've done in a while. Appreciate the opportunity. Tonight, I hope I don't bore you too much with some of the technical aspects, but just share with you some of the things I've learned and observed over the past 40 years. And I start out with a saying that I heard early in my actuarial career, that the role of an actuary is to substitute facts and for appearances and demonstrations for impressions. The application of actuarial science to helping finance and manage a CCRC is that it is simply a tool similar to what's used in evaluating defined benefit pension plans to help the management make appropriate decisions so that they can ensure that they have accumulated and set fees to deliver their lifetime contractual promises to you as residents. I hope that at the end of this session, you will take away the following information. One is that the kind of contract that you all have, a CCRC contract, or as I refer to it, as a continuing care contract, can be favorable and a good deal for a consumer. The second is that while there are myriad theories about how pricing should work out between the monthly fee and entry fee, that the entry fee is simply a prepayment of future monthly fees. Third, for this to work, this contract embodies the concept of risk pooling, which basically means that actuaries need to be good bookies. The idea is they need to guess how long people will live and how much health care they will live on average, so that for those folks who have lived a shorter lifetime or have less health care, the gain on their contracts is used to offset the loss on those contracts for people who live longer or have more health care than expected. And the reason why that's important, no one knows for sure how long or how much health care they're going to be, but you're making the trade-off in buying a continuing care contract that you'll be covered and your benefits will be received because you're benefiting from some folks who use less than the other. It's not, if you knew it beforehand, then you could probably just say, I'll just pay for it as I go along. Also identify some of the trends that I see in the industry that and you've probably read, there are very few CCRCs that get into trouble, and as they might deal with that, some of them decide to shift the risk from themselves to the consumer by changing their contract. And so you want to be aware of what things you might look at in your contract to make sure that you're covered in terms of potentially more challenging financial times. And then lastly, to assure you that this type of contract is financially sound if managed and priced appropriately. I think we have plenty of time this evening. I have about 20 slides. They will be available after my presentation. But if you have questions as I'm going along, if you want me to go back on a particular point, just sort of raise your hand and I'll repeat your question and go over it. But hopefully will talk slowly. I'm known to talk very fast and clearly so that you understand what I'm going through. Let's begin by definition. What is a life plan contract? Well, first off, it's a lifetime benefit contract. It's really a form of long-term care insurance combined with housing and shelter and room and board. And it's actually, in my opinion, the best long-term care policy you can buy at this stage. It incorporates the long-term care, that idea that when you're healthy and you're just living in your apartment, you're at your lowest cost in terms of services and so forth. But as you age and maybe become disabled and need more supportive care, be it in your home or in an assisted living nurse care center, you can pay the same or a modest fee, or a fee of a big copay, which is much less than what the costs are in that level of care. So that's covering that long-term care insurance. This works because there is a management of your care in transitions. Also, there's an underwriting when you're moving in. Initially, when you buy this contract, they're selecting healthy people. And so you have time to build up these reserves for your future health care. It's very similar to annuities, and if you have a refundable contract, it incorporates whole life insurance, and we'll talk about the refundable contract option in a minute. When I started in 1979, there were 300 organizations nationwide. A large number of them were developed in the Delaware Valley, which is really the home or the birthplace of the continuing care retirement community industry. Although there may be a couple of communities that are a couple hundred years old, virtually most of them grew out of the Quaker influence in its Delaware Valley. And I've worked with many of them, starting with Folkways and Kendall at Crosslands and so forth. In terms of the funding, what makes this unique is that you pay an upfront fee and a monthly fee that generally will increase with your inflation, but doesn't increase when you move to a higher cost center. And by a higher cost center is that when and if you have problems with your activities of daily living, you may be transitioned to assisted living. That is much more costly to provide that kind of support than when someone is just in independent living. But your fees don't go up to cover all those costs. That's because you have prepaid those future costs, or the anticipated future costs, in an upfront entry fee over time. So this allows one to pay an affordable fee throughout one's lifetime to receive these benefits and be assured that they can get the coverage they need, as opposed to if you did everything on a fee-for-service basis where your costs went up based on your needs for care. Over the years, people have categorized the contracts by type A, B, or C, which really relates to how much of a co-payment you get after you transfer to a higher cost of care. And the most extensive benefit is this type A, where you pay the same fee over your lifetime, or in some cases, everyone pays the one-bedroom fee when they transfer to assisted living or nursing care. And many people say, well, this is too risky, that this type A contract is going away. But as I've surveyed the industry, most of our clients are the type A or the type B contract, but I have not seen the type A going away. It's just a very popular type of product for people who are planners, who want to preserve their estate and make sure that they don't run out of money as they age, and that they have more health care than anticipated. And that's not the main reason we observe that people move into a retirement community. It's one factor, that financial security, but there are a bunch of other factors that are equally important. However, that financial security factor cannot be minimized, because the worst thing to happen is for your facility to run into financial difficulties and you lose the value of your contract and so forth. And I imagine you all have read over the most recent time several bankruptcies or challenged communities across the country. And the point here is that this actuarial tool was developed 40 years ago, and I'll give you a little backstory for it. Don Moon, who is executive director of Folkways, was concerned back in 1977 trying to estimate how many nursing care beds he would need. And he submitted a request proposal to the Robert Wood Johnson Foundation in Princeton. At that time, the Pacific Homes bankruptcy in California had become public knowledge. And when the Robert Johnson folks read this request about estimating healthcare beds, they decided to reach out to Dr. Howard Winklevoss, who's a Warren School professor, to try to develop something to give guidelines for financial planning for CCRCs. He was a well-known pension actuary. I happened to be lucky enough to work for him at that time and also was doing my doctoral coursework. So he got a grant to develop the financial underpinnings for this particular industry. We ended up writing a book, there'll be copies in your library, but that's how this came about. And over the years, many communities have adopted this pension-oriented approach to financial planning for CCRCs. And the idea here, the reason I brought that up, with your type A, depending on your level of copay, it's important to estimate how long people live and where they will live to make sure that you set your monthly fee and entry fee correct so that you can cover those lifetime promises. Just a little bit of history about the industry. We have the largest database in the country. We work with over 500 communities nationwide. I've been to probably more communities than anyone else in the country. And we collect, when we do a study, we collect data on each and every resident, their age, their gender, their couple status, and also their transitions to and from assisted living or nursing care. We found that typically for most single interests are female. There's about a 40% couple percentage when people move in. In terms of the contracts, there's type A, and that's where residents will pay the same fee. I'll give you the illustrations of those contracts later, is about 40% of the industry. And also we find recently there's more of a trend to offer a minimum refund contract. About 30% of the people coming in select a contract with either a minimum 50% refund or a 95% refund. This chart here shows the distribution of ages for males and females. Males are a little bit older, but it centers now around age 80. Historically, back going, when I first started, it was around 75, and it's started to increase over time. It's now the typical person coming in is age 80, but this is a distribution around that age. Not everyone is coming in at age 80. There's still people coming in, although the smallest percentage, age 75 or age 80. Even though the average age is increasing over time, it doesn't mean that the healthcare utilization for the industry is increasing. What we've observed is that that age 80-year-old today represents the same potential healthcare usage as the age 75-year-old did 30, 40 years ago. And that's an important observation in terms of the viability of the contract. If that percentage doesn't shift, and I have no reason to think so, even though people are living longer, because we're not doing things when people live longer where they're less healthy, we're doing things to keep them more healthy, that the financial viability of this contract will work on the long term. We also find, and I often ask, does moving into a CCRC lengthen your life expectancy? Well, the answer is no, not necessarily. But you all do live longer than the general population. And the reason for that, this is a select group that are screened in advance for their health and so forth. So it doesn't hurt that you move into a CCRC, but I haven't seen any studies that prove that you live longer by moving to CCRC. The average female, this is from my database, is about 11 years at age 80, about a year and a half longer than the general population, and for males, about a year longer than males. Unfortunately, males do live about a year shorter than females. And by life expectancy, that's the midway point for someone living. Doesn't mean that you will live to that life expectancy. About half of you will expire before the life expectancy. Half of you will live longer than that life expectancy. All right, are all continuing care contracts the same? I'm getting a little bit technical here, but I'm saying yes, they are. The difference is you pay an upfront entry fee, and you're promised a lifetime set of services. You're promised that you can stay in your apartment as needed. You're promised that if you need assisted living or nursing care, you'll have that, and you'll have those too. The difference is what monthly fee or copay do you pay once you're in assisted living or you're in nursing care between the contracts. They all, with all of this, they all have the same risk. The relative magnitude of that copay and that risk differs depends on whether you have a type A, where you have the maximum copay, versus a type B, which you have a lesser copay, and a type C, which you have the minimum copay. So the point is, these are lifetime contracts. They are subject to underwriting, and monthly fees don't always cover the costs that are involved, but that is to be made up by that entry fee. When we talk with our clients, the question is, we try to set the fees so that for a group of people coming in, will the fees you collect over their lifetime cover their lifetime costs? Everyone generally believes that's a fair approach, even though we're making assumptions about how we estimate those costs and what those lifetime costs will be. And that's a self-supporting fee structure. And I'm going to show you a chart a little bit later on how that works out for you. But the concept is that we could do pay-as-you-go, where basically like our Social Security system, it's on a pay-as-you-go basis. And as you may have read or heard, it has problems because it wasn't actuarially funded. The idea is that as that work ratio between working people and retired people shifts, there's an imbalance there. We could have avoided that by doing actuarial funding along the way and avoid those problems. But the government, since it can raise tax rates and so forth, didn't have to do that. On a CCRC, you can't just raise your monthly fees higher and higher, your entry fees, to cover a misstatement in how you set up your fee structure to begin with. And that's really the point of actuarial analysis for a CCRC. Let's minimize those unexpected changes in fees to the extent we can. It's not perfect, but the idea is let's not set up something that's going to be at a high risk of failure from the very start. Another thing I want to mention about the refundable contracts, that's a recent trend, and that's a case where when they were first offered, many communities based that refund on a repayment from a future resident coming in. There is a better way to do that, an actuarial way to do it, very much like a whole life insurance policy. An actuarial tool gives your management the tool to be able to price out that refund provision, so you're not dependent on the next person taking a refundable contract. You can have a mixture of contracts. Let's just talk a minute historically about contracts. When I first started, pretty much communities were two levels of care: independent living and nursing care. And there was a lot of pent-up demand. And interestingly enough, they were worried about how to care. By pent-up demand, I mean people were not sick enough to be in nursing care, but there was no assisted living back in the 80s. So they would keep them in their apartments and support them there. Interestingly, that trend is coming back now because people are talking about aging in place. How many people are familiar with that concept? Everyone is, of course. I mean, the idea is now people no longer want to be moved to assisted living nursing care. Let me get those support services in my apartment. Well, 40 years ago, the idea was that was a problem because we wanted to move people to the appropriate setting and so forth. And so the early contracts were basically the number of nursing care days you had, either a specified number of days or unlimited, which was a type A, or maybe all your temporary days where you're expected to go back to your apartment for free and then stay there. And then typically refunds for death were less than 12 months. After that, you got no refund. Over time, the industry began to mature, and they added assisted living to meet that pent-up demand mode so people could be in the appropriate setting as they needed support and so forth. Although now we're trying to work through whether or not people should get this aging in place. I don't think there's a right answer for that. It just depends on the philosophy of the community. The one drawback when you really go to the extreme of pent-up demand and you're trying to market to active, healthier, younger folks coming in, when they see people with a lot of walkers and wheelchairs, there's a deterrent for them to want to move in to your independent living center, depending on how it's set up. If they're cottages, it doesn't matter as much as where you have one central sort of facility. Also, the advent of refund provisions. One of the concepts is that with this upfront entry fee, folks are concerned that if I die early or don't use a lot of health care, can I get money back for what I didn't use? And that's sort of a contradiction in the concept of the risk pooling that underlies this contract. Let me just restate that again. The idea is that if on average you're going to live 12 years in a CCRC and you're going to spend 3 years in health care, no one individual will likely do that. That only works if for the people who live less than 12 years or use less than 3 years of health care, the gain on their contract and their fees is used to offset the loss on those folks who live longer than 12 years or use more than 3 years of health care. That's just sort of simplification. But that risk pooling is very important for this contract to work and so forth. So then to get money back, you need to add on another amount to accumulate to what that refund is expected to be over the resident's life expectancy. That's just the way the math has to work out. There's really no free lunch. So, and I realize these are big numbers. This could be hundreds of thousands of dollars you're talking about, but the deal you're kind of accepting when you move into a risk pooling type A contract is that I'm accepting, in fact, I don't know how much health care I'm going to need or how long I'm going to live, but if I live longer than expected, I'm covered because management has set fees so that for those folks where they got a gain, those fees are used to cover my extensive use. And that, I would say, actuarially is a fair deal and so forth. There are contracts where you can go strictly fee for service, like a rental contract, where you could go in and say, I'll pay for my costs as I incur them, and that may be appropriate for those folks who don't want to, who are willing to accept that risk and have the resources to cover whatever amount of health care or longevity they may have. And let's just go through this example. The median cost from our clients across the country of their life care contract is $750,000. What that means is that when you sign a contract with a CCRC, you're signing a $750,000 contract. This is based on roughly about $4,000 a month while they're in AL, in independent living. And in this case, this example, they're living 9 years in independent living, 2 years in assisted living, and then another 1 year in nursing care. When I accumulate all those dollars over time, they come up to be about $750. $750,000, sorry. That would be a heck of a deal. So let me ask you this question. If you're signing a contract for $750,000, do you think it's fair that you pay fees roughly equal to $750,000? All right. That answer is generally yes whenever I ask that of boards or other residents. I mean, the point is if you're buying something that's worth $750,000, you should pay for that. There's no free lunch. Now, the point is you may actually only use $500,000, but you don't know that beforehand and so forth. So that's the concept of risk pooling. At the same token, you may cost $1.2 million. And the idea for that, you're willing to take that risk from a planning viewpoint that regardless of what you end up being, that you're going to be covered and so forth. So in that same vein, if you wanted to cover your own costs, then you should buy, I suggest, a monthly rental contract. In this case, the cost for being in independent living is $36.94 per month. So for those 9 years, you would pay that $36.94. Then when you go up to assisted living, you'd have to pay $83.54. And then if you, for that 1 year in nursing care, you would pay $13.239. And in that example, you'd have no entry fee, no prepayment of fees. Does that make sense to folks? Again, these numbers are based on whatever your community's costs are. They're just an illustration based on our median situation. Now, what if you want to say, well, okay, I'm okay with paying something up front. What if I pay $4,000 a month on my monthly fee, and then but I want to pay that $4,000 forever because I don't want to take the risk of having to pay $83.54 for 2 years, or maybe I might spend 5 years in assisted living. Or the same thing in nursing care. Can I do something that with this risk pooling so I can pay the same fee regardless of how long I will live? Well, in this case, this is a type A contract where you're paying $4,000 forever, and in that case, that entry fee, you see this small shortfall between $4,000 and $36.94, a bigger shortfall between $83.54 and $4,000, and even bigger between $13.239 and $4,000. That sums up to be about $180,000. So for an actuarially fair pricing structure for this type of contract to cover that $750,000, it would be $4,000 a month for your lifetime plus the $180,000. And that would be the right fee for that. Again, I've simplified to ignore the impact of inflation and interest and so forth, but that's how this basically works. So this would be how type A pricing would be. If you did their type B, where you had a higher copay, let's just say that we're going to pay 90% of the assisted living or nursing costs and still pay the same, a little bit less on the month fee while an IOU, that entry fee can drop down to $38,000 because we got a smaller shortfall when we get to assisted living and nursing. But again, over the resident's lifetime for both those contracts, we're expected to collect $750,000. This is what actuarial science does to help management figure out what those fees should be based on whatever your costs are and what the assumptions are about your longevity and your healthcare usage. Now, one thing I didn't mention, when we do an actuarial study, we analyze the prior experience of residents of a specific community and tweak our standard assumptions to match their experience. So those assumptions about longevity are matched toward what the community's experience and so forth. So we try to do it as close to what we expect the community's experience to be. However, we don't have a crystal ball, so we're likely to be inaccurate. But the key thing is having that regimen and updating these regularly gives you a sense of keeping things in track, so you don't have to make big adjustments down the road. One point I want to mention, no matter whether you have a high copay contract or a medium copay contract or a low copay contract, all contracts have some risk. Life is about risk. I remember when we looked at the Pacific Home bankruptcy, some of their contracts advertised retire from inflation. In other words, they paid an upfront fee and never paid anything else again. Well, that just won't work. That's just a recipe for disaster. When you move into a CCRC, you can't retire from inflation. There's going to be some healthcare risk, there's going to be financial aid risk, there may be a refund risk, and also selection risk. Now, what I've done in this chart is to say, going from the type A to the rental, which is the pure fee for service, that as you go from the type A up here, the healthcare risk is the maximum in terms of someone using more healthcare now, and it goes to a minimum when you go to rental because you're paying everything fee for service. However, your financial aid risk is lower and gets to your highest when you go to fee for service, because you could very well as an individual run out of money if you live a long time or have a lot more health care than the average. So there's no perfect, well, while there's a cross point here, I don't know what that perfect contract is. If I did, I would probably be on a beach somewhere in the Caribbean, just like I would have sold that a long time ago. But the point is, you can't get around risk, but what's important for you as a consumer to choose the contract provisions with the copay that fits your own particular financial situation. And in this regard, in terms of the financial aid risk, that's often overlooked when you move into community. The type A contract is very similar to the kind that you have, represents the lowest financial aid risk. In other words, once you're qualified to buy that contract, it's very likely, no matter how long you will live, that you'll run out of money, because certain portions of your income will probably increase with inflation, including your Social Security income and others. But if you do a type B or C where the fees go up as you transition to assisted living nurse care, it's more likely that you may run out and deplete your resources. What I've observed is that virtually every CCRC in the country practices non-discharge of residents if they run out of money. Now, they're not obliged to do that, but the reasoning I've been told is that virtually all the communities we work with are 501c3 or nonprofits. They do not want to risk their 501c3 by discharging a resident who has depleted their assets, even if they've done so irresponsibly and so forth. That doesn't mean that will happen here, but just in general, you're pretty secure that if you, many of them have foundations to help subsidize residents who run out of money, you're pretty secure that once you move in and once you've been qualified financially, that you won't be asked to leave if you run out of money, which is a good deal in terms of planning and so forth. But my point is, as you go up to the lower copay, the fee-for-service contract, you are exposing yourself to more financial aid risk. Often I'm asked, well, not that often, but some people ask, how do I financially vet a CCRC? And I've struggled with that question, and in the process of writing an essay about it, I don't have a simple answer yet. But my rule is that ask your provider 2 questions before you move in. One is, and you either have your financial planner to ask this. One is, how much is the contract worth? if they don't know how much their contract is worth, that $750,000 number I gave you, then how can they price it right? I don't know how they can. I mean, because they're doing it just by the seat of their pants. And then secondly, ask them if they do know the number, say, are the fees set to cover that? And they say yes and can show that to you. Then that means your provider is practicing a systematic method to ensure that they can deliver your lifetime promises. It doesn't mean, now the point is, even if they may have a deficiency in their pricing now, that doesn't mean that they're about to become bankrupt or they're on the wrong track. The fact that they're measuring it gives them the opportunity to fix any problems they may have slowly over time before they become a real crisis. But it's very important for your provider to be able to say, yes, our contract is worth X amount of dollars, and here's how we price it, and we determine that that price is equal, those fees are expected to cover those costs. With the caveat that, yes, these things are based on assumptions, and those assumptions may be wrong, but that's the right starting point. It's very hard to get an assessment of financial solvency from the GAAP financial statements because the GAAP financial statements are not geared for insurance-like products. In the insurance industry, we use statutory accounting to represent our financial status, and that's really what needs to be done here and what the actuarial tool does for this particular industry. Well, a couple things. I'm sure you heard about a few of the bankruptcies, like in New York with the, I think it's Harbor Side or something like that, and down in North Carolina where the insurance department took over Aldersgate. Yes, CCRCs do have bankruptcies or financial challenges. They're few and far between, but that doesn't mean that they aren't very stressful for residents. They're big news, but the point is many can be avoided if management focuses on managing their liabilities and not the cash flows only. And the challenge is you get these influx of entry fees, you think because you have $10 million in the bank, $20 million in the bank, they ignore the liabilities that go along with that and tend maybe not to raise fees or adjust fees appropriately to make sure their reserves are in balance with what their future liabilities are. Because in virtually every continuing care contract, the monthly fees are not covering the entire cost when a resident incurs them. So you have to draw on these reserves to make sure things stay in balance. In the 1960s, the Pacific Homes was a very big bankruptcy. In the 1980s, I worked with Prudential as an expert witness when they were sued regarding their financing of the John Knox villages across the country. And unfortunately, the residents still got their benefits, but the idea there was additional stress, and Prudential got sued because the plaintiffs were saying, you should have known that this community was not set up on a financially sound basis as an insurance company. Why did you lend money to them? And rather than go to trial, they decided to settle with them for about $12 million in cash and forgave about $200 million of mortgages for about 5 or 6 John Knox villages across the country because they wanted to be an active player in the senior market, and that was bad PR for them. And now, recently, we hear about a lot of communities where, when it comes to the refundable fees and dealing with bondholders in terms of residents not getting their refunds timely. This industry is a good industry, but some of the financial practices need to be changed on their own, external to having regulation charges. There was a Senate committee in 2010 that looked at this industry. They did not recommend national regulation, and you all want to avoid that. But this industry, in my experience in working with providers, that they are well-intentioned, but they need to apply the right tools consistently to make sure their promises can be delivered. And I can pretty much trace all of the recent problems to inappropriate financial practices in terms of dealing with refunds, et cetera. So my point here is that you're involved in a safe industry, and as long as your provider is willing to look at this from a scientific basis, it should be safe. But it's not 100%. You can't guarantee full accuracy. I had one client who did an actuarial study from the very beginning and expanded, this was out in California, just before the real estate crisis in 2008. They increased their size by 50%. Well, once they did that and the crisis hit and no one had a warning that was going to happen at that point, it took them several years. They actually ended up going bankrupt because they just had too much overhead and debt because they expanded by 50% a few years before. But generally speaking, it's a relatively safe entity, institution, and so forth. Any questions on that comment? My point here is that these are complex contracts. I've studied them for years, and yes, it is interesting. You can read our book if you want to really get into the details, but the bottom line is that really, has your provider looked at what the long-term costs are based on their budget and you all's residents' experience and tried to quantify what the long-term costs are? And if so, have they tried to set fees that over a typical resident's lifetime, the combination of the monthly fee and entry fee will cover those costs? Now, two things to mention. Monthly fees are likely to be adjusted from year to year. You cannot or you shouldn't write contracts to limit monthly fee increases to Social Security increases. What affects your increases is the change in your internal operating budget from year to year. So pretty much if you buy a continuing care contract, you're locked into a contract that has an upfront fee and monthly fees that will adjust year to year based on your internal costs, your internal inflation. So if there's something like in California they've had some liability crisis so that operating costs went up 10% in 1 year, then monthly fees probably need to go up at that rate. But if you have very good experience, they may go up only 2%. But it's independent of what Social Security will be. But by and large, you're looking at fee adjustments from year to year with the idea of a nonprofit is to set budgets that provide a service to you with a minimum amount of profit and extraneous overhead. Then the other risk is that when it comes to refundable fees, and most providers don't like when I say this, refundable fees are, I understand why people want a refundable fee. You're here, if you die, your heir, you want to give something back to your heirs. But if you remember in the beginning here, I talked about the risk pooling concept. The idea is that if you have a non-refundable fee, if there's a gain on your contract, that gain is necessary to cover that loss associated with someone else who lived longer. It has to work that way since you're not paying for your individual costs. So one has to accept that maybe $200,000, $300,000 is for this prepayment of services is a risk that I'm willing to accept for buying into this contract. There's no way to get around that. And so, or if you do want a refundable fee, maybe look to take that additional fee and invest it on your own and take the risk that you won't live for a few years, but use it that way. Are CCRC contracts viable, economically viable? I believe that they are after 40 years of study. It's a good buy. It's just one aspect of why you would move into a CCRC. There are many other aspects that are beyond my level of expertise, but the free security, the freedom from loneliness, etc., the camaraderie that you all experience here. I haven't moved into a community yet, and I may very well at some point, but you all know why you're here and how much this is an enjoyable deal. But from a financial viewpoint, they are a safe bet, so to speak. Doing actuarial studies is not a panacea. It's simply a tool with the appropriate assumptions to help management and the board make the correct decisions to ensure that they accumulate reserves that so they can meet future obligations. It's not intended so that you can be overcharged or undercharged. You just try to get a balance of what's fair to be able to deliver those services. But regulation isn't going to solve the financial issues for you. You can't regulate full occupancy. Communities that are full are able to maintain and keep going. So my recommendations for most providers is to do the actuarial funding, and for consumers to say, we want our liabilities to be funded on a regular basis, to be actuarially funded, and you to confirm that with us, and understand that gap statements are only a first step, but they don't answer that question for you. So it's just becoming educated and just asking. There's a thing known as actuarial standards of practice number 3, and a concept of an opinion of satisfactory actuarial balance. Ask your provider if they're in satisfactory actuarial balance, and if the answer is yes, what that means is the following. They've looked at the current cohort of residents, projected out their lifetime costs and liabilities, compare that to future monthly fees and existing reserves, and those future monthly fees and existing reserves, assuming monthly fees go up to match internal inflation, are in balance. That's number one. for pricing for fees for new entrants coming in. They've looked at the value of the contract for them coming in, and the combination of the monthly fee and entry fee cover that cost, which you all said that's a fair deal for y'all. And then lastly, they project out cash flows for at least 10 years to make sure they meet any bond covenants. That's what satisfactory actuarial balance means, and that's the highest financial standard for a CCRC to meet. And if you're in that situation, you're 99% sure that this community is going to go on and on forever and ever. I can't guarantee that though, but it's, you minimize the risk financially for you in this community. And you may say, okay, Al, you think, AV, you recommend this actuarial a lot. Can this be applied in the real world? We go back 20 years doing our actuarial analysis, well, longer than that for our communities, and each year we summarize our results. This is over the last 5 years. Above the 0% are those communities that are in satisfactory actuarial balance. 80% of our clients are in satisfactory actuarial balance. And what that means is that, to me, even though I believe our clients are those who are more financially astute, that marketplace fees are attainable and it can be actuarially sound. And also, I would say, even those communities that are in the red, that doesn't mean that they're running out of money. They're more on a pay-as-you-go kind of basis as Social Security, so they're kind of locked into their contract. If somewhere down the road you can't sell a continuing care contract, maybe it has to be an equity contract, they're going to have to deal with this liability on behalf of those current residents and how they do that. But with those that are in satisfactory actuarial balance, they can make that transition in the future in terms of contract variations. But the point is, yes, being in satisfactory actuarial balance is a good position. We have 3 categories here, just so you know. Being in satisfactory actuarial balance, you should have an appropriate surplus. The top category is what we call AVP seal. That's our top half of our clients. They're still satisfactory actuarial balance. They're really, I can't say they're not better. They're just in the top half of our clients are in satisfactory actuarial balance and so forth. But the ones in the 38% and 35% are both fully sound and so forth. What about the future? As I mentioned when we first started talking about in the 70s when there were just 2 levels of care, I've seen some trends in the industry where people are pushing back because they say, well, when I do this aging in place, your contract was based on a facility orientation for your fees. So if you do home care, we're going to charge you extra for that. Really, from an actuarial viewpoint, it's not about the location of where the supportive services are coming in for someone who needs assisted living help, level help, or nurse care help. It's just the additional costs associated with that. So you may look at contracts in the future that really are more defined on ADLs and so forth. It really doesn't matter where you get that cost of care. Now, the truth is, providing assisted living level services in an assisted living facility is cheaper per person than it is doing it at home. So you may have to pay a little premium for that flexibility or that desirability. But the point is that same continuing care contract still works now as things change if you go to ADL. So you may want to look in terms of changing the contracts over time for that. And then also on the refundable contracts, just be aware that depending on the next person to buy your unit to fund that refund is a very risky proposition. Better to have it actuarially funded or to take that additional dollars for the refund and just invest it on your own and hope that you'll live past the life expectancy so it accumulates to the amount you want to get back. But that entry fee, that non-refundable fee, is really a prepayment for future services that you may or may not use. And basically, that's what I'm saying in design, that, the co-payment really is a variable kind of situation. Depends on whether or not, how much you want to pay to get your health care. But the whole idea behind actuarial pricing is to minimize intergenerational funding, that you're not depending on the next generation to fund your costs and vice versa, but you're depending on the next generation to keep it full so everyone can share an equal amount in that overhead. And I had to show a picture of me 20 years ago. At this point, we have questions and answers, and I'm happy to go over anything that I missed at this stage.
Thank you very much, Amy.
Thank you.
So, any questions? We have one over here, Dan. Dan, can you get a microphone to Dan?
Testing. Dan Seeger, B107. Thank you, AV. That's a wonderful presentation. I'm wondering if you could tell us why providers are reluctant to share with residents the reports that actuaries make describing the actuarial balance of their particular community. We invest in the community. It seems logical that we should be able to see what our actuarial balance is.
Well, that's a fair question. I can't speak for any particular provider. Some do, some don't, but you should note in doing an actuarial study, there are many assumptions involved. We're basically building a business model of your community. We start with the operating budget approved for the current year, the balance sheet, and then we customize the actuarial assumptions about your longevity and healthcare utilization based on analysis of the historical experience of the residents in that community. Ultimately, there's one set of what we might call baseline assumptions, which the board and management think are reasonable and a fair representation of the future. They may or may not do additional sensitivity. So it may be that, you know, the point is, reasonable people can disagree about what the baseline assumptions would be, but they may say, this is the final set we're going to work with, and so possibly they may not want to, you know, endless debate on what those assumptions may be, but ultimately the key thing is if you're in satisfactory actuarial balance and so forth. But I don't know why. I would hope that in the future, over time, because I think that the idea that my two rule deal here is that what is the value of my contract, and are you setting fees to do that? That's what the opinion, satisfactory actuarial opinion means, that we're doing things that are financially sound, that why the Robert Wood Johnson Foundation funded this grant, and what the book is about in terms of it helping ensuring these commitments are met.
Okay, we need a microphone up here, and was there one in the back too? Oh, before you.
Doug Meeker, I live in Berkeley. I was wondering if there's some relationship here between this and renter's insurance. I'm trying to think of the, not renter's insurance, but the taking out a loan so that you live with the rest of your life.
I mean, like a reverse mortgage, Doug?
Reverse mortgage, I think.
They're similar. In fact, I didn't discuss, there's a concept known as continuing care at home, which again was developed by Don Moon, and it's a concept where instead of moving to a CCRC, you get the health care, long-term care benefits, but you can stay in your own home. And I know there's a group in Arizona who's developing reverse mortgages and providing with an at-home, a continuing care at home type product. So it's very similar to that, but it's that long-term care component, that insurance component that's involved in this contract that uses the risk pooling to make it work. And when it comes to the refundable portion of it, that's where an additional risk comes in. It shouldn't be combined with that if possible, if that answers your question.
I have the mic here. Hi, Lisa Taylor, thank you. It was very clear. Love graphs. It's hard. We have a very nice memory care downstairs, wonderful nurses, comfortable rooms, and socialization. At least people get to eat together and see each other, which I think is crucial to any kind of mental capacity. I can't understand why in home care, one, I don't see who could get to your room fast enough in an emergency, and two, there'd be no social stimulation. To me, it's very grim to think of aging by myself in my own bedroom until I die. So would you explain to me that transition?
You raise a good question because, again, I started in the 70s, and this trend of aging in place is something that's relatively recent, and people are touting it. But your point you're raising, you're by yourself. You don't have the value of a CCRC is just this socialization of seeing people and not being alone and so forth. But I guess each individual is different, and there's room enough in this aging population for both CCRCs and home care to work. There's no one right answer.
Yes, no, I guess I didn't phrase it well enough. Talking about our particular CCRC, and since it's obviously both socially more interesting and less expensive to live to be in our own facility, why would any CCRC want to offer aging or could demand, which is that we age in our own small bedrooms?
Well, what I've observed is that it's really the residents who ask that. In California, they build, I know one community that's built to be earthquake resistant, so they don't have to move at all, but it's really more the consumer who's asking to stay in their apartment for their entire lifetime and not moving along the way.
But do we have a choice? Does a resident have a choice, or does it go one way or the other?
It depends on the organization. I really can't speak for each organization. It just depends on how the organization has set that up. But typically what I've seen is that I've seen lawsuits. I have a client in South Carolina where the person signed a life care contract, and the contract clearly said, we have with a committee of your family and our medical director, et cetera, can move you to assisted living or nurse care or memory care with your contract. And they sued and won the right to stay in their apartment. So it's an individual preference more than anything else in terms of not moving.
Marguerite Chandler. So my question has to do, I'm over here.
Oh, sorry.
My question has to do with the for-profit industry. I mean, this senior demographic obviously has grown. It's attracted a lot of financial interest, and for-profit, the competition from for-profit groups seems to be getting greater and greater. So how has that affected the model, or has it affected it at all?
For-profits has been around for a while, and the claim is that for-profits are more efficient than nonprofits are inefficient how they're managed and so forth. We don't do operational reviews, so I can't really say that's yes or no, but 99% of our clients are nonprofit, and I think they're run well. For-profits do have a big advantage because they have access to capital, and they may be the dominant factor in this industry in the future and so forth, in terms of just meeting the housing needs for seniors and all. But I guess I've been very fortunate in working with well-run and well-intentioned nonprofits. So I think that's really the way to go if I were to move into a CCRC.
I think there's one in the back. Doris?
Hi, Doris McKenzie. I have a question about more and more people are desiring to stay in place, as you said, and many of the CCRCs are designed to change in location is what makes a difference. Now, are new contracts, CCRCs coming up to allow people to stay in place and have an actuarial estimate of the costs on staying in place, and making that change? Are some of the existing CCRCs making financial decisions around that change?
Good question. And let me just pull this slide back up here. It should be a relatively straightforward transition from each community is different how their contracts interpreted, and I've also spoken with some elder care lawyers in terms of how they're talking to providers and getting them to implement the contract. The idea is that, as I said, let's just take someone who's now qualified for assisted living. Traditionally moving to assisted living, let's say we provide that assisted living support in their apartment. Well, that may cost a little bit more, so the contracts need to be modified fairly so that at least you get the coverage that the dollar amount of coverage that you would got in assisted living, and for you to have the option to stay in your home, you may pay a little bit more. That would be a fair way to do it. But I'm not seeing people work through it yet. It will come ultimately. You're going to have flexible contracts to handle those contingencies, because people are now getting rid of nursing care altogether and not even building nursing care units. There's a trend for that. But my point is, if someone has all 5 ADLs, they're going to need nursing care-like services, regardless of whether you do it in a facility or in a home. And it's more efficient to do it in a facility where you can do the staffing and service 60 people at one time instead of going around in various places within your infrastructure and independent living. So a change is coming, I would say.
Any more questions? We have time for one or two more.
Judy Clean, P203. Right now we're seeing the beginning of the baby boomers coming. I know we have a waiting list for any 2-bedroom or sized apartment, sometimes 4, 5, 6 year waiting list. Is anybody thinking about what happens when the baby boomers aren't coming anymore, when that is tapering off? What happens to all the institutions that are out there?
Everyone's very excited about the growth, the growth and demand from the baby boomers. I'm not aware of any studies about when that decreases, but you all cover the whole world industry. 1,900 facilities covers less than 1 million seniors at this stage. So you're really a small segment. It's not a mainstream product at this stage. So there's plenty of room for growth at this stage.
Norval?
Yeah, very briefly. Given the current economic situation and changing assumptions all the time, how often should actuarial studies be conducted of an existing CCRC? And second, should the results of the study be shared with residents?
You know, I'm going to avoid that second question, but the majority of our clients do it on an annual basis as part of their budgeting process. Yeah, it is, because it's part of your pricing process to see where you are, so that way you can make minor tweaks if you're out of balance without having to wait 2 or 3 years and make a major increase in fees. But it's an essential part of the budgeting process. No, the board sets a policy. We want to be in satisfactory actuarial balance, which means a funded status of say 5%, and things may happen that if you're below 5%, it tells you if your internal costs went up 4%, do I need to increase them 4% or 6%, or can I increase them 3% and still stay in sync?
Okay, I think that's it for tonight. AV, thank you so much for coming.
Thank you.